The financial establishment just admitted they have no roadmap for what's happening right now. Uncharted territory. Those were Reuters' exact words when describing where silver prices are headed. While you were offline during the holiday weekend, a document was published halfway around the world that changes everything we thought we knew about global silver supply. The number on your screen right now, $79.30 per ounce. That's a price level humanity has never witnessed before. And what just happened in Beijing explains why this might only be the beginning. I'm here to break down the most significant policy shift in the silver market since China began building strategic reserves. What I'm about to show you isn't speculation or hype. It's documented policy from the Chinese Ministry of Commerce that was released when most Western markets were closed. Stay with me because the implications of this are staggering. Before we dive deep, smash that like button if you want to see more analysis on precious metals markets, drop a comment with your perspective on what's happening, and subscribe so you don't miss the next update. Let's start with the facts. During the Western holiday period, when the New York Stock Exchange sat idle and liquidity dried up, China's Ministry of Commerce published document number 68 of 2025. This isn't getting the attention it deserves in mainstream financial media, but it should be front-page news. The document outlines China's framework for managing state-controlled trading and exports of silver for the 2026 to 2027 period. Now, you need to understand what state trading means in the Chinese context. This isn't a free market system where companies make independent decisions based on price signals. This is Beijing telling every silver producer in the country that exporting even a single ounce requires government qualification, compliance verification, and explicit permission. They've established an annual output threshold of 80 tons for newly applying silver producers. For Western regions of China, that threshold is adjusted lower, but the core principle remains unchanged. The state controls the flow of metal across borders. China is the world's third largest silver producer, mining millions of ounces annually. This announcement means that for the next 2 years, every single ounce of that production will require government approval before crossing the border. This isn't a tariff or a tax. It's fundamentally different. It's a control mechanism, a valve that Beijing can adjust based on their strategic priorities. Consider China's industrial trajectory. They're the dominant force in solar panel manufacturing. They're aggressively expanding electric vehicle production, and they have massive semiconductor ambitions. All of these industries consume silver in enormous quantities. Given these domestic needs, the question becomes, will they prioritize exporting strategic materials to Western markets? The timing of this announcement raises eyebrows. Why publish during a Western holiday when media coverage is minimal and markets are closed? Why drop this news when traders are away from their desks? The market will open on Monday morning to discover that the global supply equation just fundamentally changed while everyone was distracted. Reuters highlighted this week's surge in silver prices and the rising anxiety about industrial supply chains. They even quoted Elon Musk expressing concern on social media, stating this is not good, and noting that silver is needed across many industrial processes. When someone running multiple companies that consume massive quantities of silver publicly expresses supply concerns, that statement carries weight. Think about the position of Western manufacturers. The world's largest electric vehicle market, China, is now restricting silver exports while every Western automaker is attempting to ramp up EV production. The country manufacturing 80% of the world's solar panels has just announced their domestic needs come first. Supply chain managers at major technology companies, those responsible for securing components for data centers, AI infrastructure, and semiconductor facilities are looking at this Ministry of Commerce announcement and running calculations. Let's examine where we stand right now. Spot silver is trading around $79.30 per ounce. The bid-ask spread remains tight. roughly $79.27 to $79.39 according to Kitco. Despite this massive price move, there's still liquidity in the paper market, still two-way flow. But the physical market tells a different story. Reuters reported 27,870 tons of silver in London vaults as of the end of November. That translates to roughly 874 million ounces. Now here's the context you need. The iShares Silver Trust, ticker SLV, alone holds approximately 529 million ounces. That's over 60% of the London vault inventory tied up in a single exchange-traded fund. When you add other ETFs, industrial reserves, and allocated accounts, that 874 million ounces starts looking considerably thinner. And the CME Group futures contracts? Longs are standing for delivery. They're demanding physical metal, not rolling their positions forward. With Chinese exports now subject to state approval, one of the major supply sources to Western markets just became uncertain. Peter Grant, Vice President and Senior Metals Strategist at Zayner Metals, was quoted by Reuters pointing to $80 as a plausible near-term objective. We're less than $1 away from that target, and that analysis was provided before the full implications of China's export rules had been fully digested by market participants. The technical setup is extraordinary. FX Empire published analysis showing silver closed the week near $79.30, framing the move as a breakout with upside targets in the $81 to $82 area. But here's the critical data point. The RSI, the Relative Strength Index, is near the high 80s. In typical market conditions, an RSI above 70 is considered overbought. Above 80 is extremely overbought. An RSI in the high 80s is historically unusual. It suggests momentum so powerful that normal mean reversion patterns aren't applying. The market isn't respecting traditional technical boundaries because the fundamental narrative is overriding technical signals. Daily FX describes silver's rise as wild and meteoric, noting that price action remains strongly bullish, but warning that silver is behaving more like a high volatility momentum asset than a traditional precious metal. Translation: the old playbook doesn't apply. Silver has decoupled from its historical trading patterns and is now moving on pure supply-demand dynamics combined with momentum psychology. Make sure you're smashing that like button if this analysis is valuable to you. Comment below with your take on these market dynamics. And subscribe to stay updated as this situation develops. You're going to hear the word bubble repeatedly in coming days and weeks. Tony Sycamore, market analyst at IG, was quoted in The Guardian describing a generational bubble dynamic as capital pours into precious metals. That word is designed to trigger specific psychological responses, images of tulip mania, dot-com stocks, housing in 2008. It's meant to activate loss aversion. But let's examine what actually constitutes a bubble versus a repricing event. Was there a bubble in oil in 1973 when the Arab embargo created a supply shock? Was there a bubble in palladium when automotive demand exceeded mining supply? Was there a bubble in uranium when the nuclear renaissance began and utilities scrambled for fuel? Those weren't bubbles. They were repricing events. The market was adjusting to a new supply-demand reality that previous pricing hadn't reflected. The distinction is critical. A bubble is driven by speculation divorced from fundamentals. A repricing event is driven by fundamentals the market previously underestimated or ignored. Look at the silver fundamentals objectively. Global mine production has been flat or declining for years. Industrial demand is expanding due to solar panels, electric vehicles, 5G infrastructure, and data centers. Investment demand is increasing as central banks expand their balance sheets. Recycling cannot keep pace with consumption. Above-ground inventories are being drawn down. And now China, one of the largest producers, is implementing export restrictions. Those aren't bubble conditions. Those are supply crisis conditions. And prices in a supply crisis do what they're designed to do. They rise until demand is rationed or new supply emerges. Rona O'Connell, head of market analysis at StoneX, warned in a Reuters analysis that the rally has been heavily investment-driven and that while upside can extend, reversals can also be steep. She's correct about the mechanics. In momentum-driven markets, when flow reverses, moves can be violent. But there's a larger context here. The investment flow isn't random speculation. Capital is seeking alternatives as purchasing power of fiat currencies declines against tangible assets. Institutions are recognizing shifts in the relative value of paper assets versus real resources. This is front-running of a supply situation that's becoming increasingly undeniable. Nitesh Shah, commodity strategist at Wisdom Tree, described the setup as supportive, given demand and inventory dynamics. That's diplomatic language. The more direct assessment would be that we're sitting on compressed demand against constrained supply. There's another dimension to this that hasn't fully materialized yet but is worth monitoring. Reuters reported earlier that the US critical minerals list was expanding under a Section 232 investigation into critical minerals import dependency. Silver was explicitly mentioned among metals under consideration. The US government is becoming aware that massive quantities of strategic metals are imported from countries whose interests may not always align with American interests. They're evaluating tariffs, restrictions, and policies that could further impact global silver supply at a precarious moment. Citi analysts warned that markets may be underpricing certain tariff risks. For silver, tariff risk matters because it affects where inventories are stored, which region sets the marginal price, and how quickly physical supply can respond to price movements. If the US implements tariffs on silver imports, metal currently in London, Singapore, and Hong Kong becomes more expensive for American buyers. ETFs face higher sourcing costs. Industrial consumers pay more for every ounce required. Consider the position of an American solar panel manufacturer in this environment. They need silver for their panels. China is restricting exports. Mexico, the world's largest silver producer, faces political uncertainty. The US might impose tariffs making imported silver more expensive. Where does supply come from? They compete with every other industrial consumer globally for a shrinking pool of available metal. The major physical market is the London OTC market, supported by bullion held in large bank vaults. But those vaults aren't infinite warehouses. The 27,870 tons in London isn't sitting idle waiting for buyers. It's allocated, committed, backing ETFs, industrial contracts, and bank obligations. When delivery demands increase, when industrial buyers scramble for supply, when export restrictions tighten and tariffs potentially get imposed, that inventory gets drawn down rapidly. Let's talk about the immediate future because the next 48 hours are critical for price discovery. Tonight, Sunday evening, CME Globex silver futures reopen. This is when the market begins processing the China news. This is when algorithms start running their models. This is when price discovery happens for a development that occurred while markets were closed. Monday morning, the US stock market opens. SLV and silver mining stocks will begin trading at prices reflecting whatever happened overnight on Globex. If silver runs to $82 on Globex overnight, SLV opens dramatically higher than Friday's close. Retail traders who set limit orders over the weekend get filled at unexpected prices. This is gap risk, and in a market this extended with momentum, this powerful, gaps can be substantial. If silver reaches $85 before the US market opens, we're looking at gaps of 7 or 8%. This is how squeezes accelerate. This is how orderly markets become disorderly. Watch the macroeconomic data and Federal Reserve commentary this week. The rally has been amplified by expectations for Federal Reserve easing in 2026 and a softer dollar. If the Fed signals rate cuts are approaching, the dollar weakens further and silver benefits. If inflation data comes in elevated, the real value of cash deteriorates and hard assets become more attractive. The macro backdrop is supportive from multiple angles. Also monitor the physical market. Watch the premiums dealers charge over spot. If premiums expand, if delivery times stretch, if products show as out of stock, that's the signal that paper pricing is diverging from physical reality. That's the signal that the squeeze is intensifying. The $80 level is the immediate psychological target, less than $1 away. When that level is breached, and many analysts expect it will be, the next psychological target is $100. From 80 to 100 represents a 25% move. In normal market conditions, that would take months or years. In this market, with this momentum, with these fundamentals, with China restricting exports, and the Fed potentially easing and industrial demand accelerating, it could happen in weeks. Before we wrap up, if you found this analysis helpful, smash that like button one more time, comment your thoughts on where you think this market is headed, and subscribe so you catch the next update as this situation continues to develop. The trajectory isn't linear, it's potentially exponential. Think about what $100 silver means for the global economy. Solar industry economics change dramatically. Every electric vehicle becomes more expensive to produce. Data centers and AI infrastructure face higher input costs. The green transition becomes more expensive precisely when governments are trying to accelerate it. The industrial economy adapts to a new reality where a critical input has repriced significantly higher. The historical gold to silver ratio averaged 15 to 1 for most of human history. Today it sits closer to 80 to 1. Even with gold prices remaining flat, a reversion toward the historical mean implies substantially higher silver prices from current levels. And gold isn't staying flat. Gold is hitting all-time highs alongside silver. The entire precious metals complex is being repriced. Reuters reported that silver has notched a massive year-to-date gain, outperforming gold by a wide margin in 2025. Silver is outperforming the ultimate safe haven metal. That tells you something about the nature of this move. This isn't purely a flight to safety. It's recognition that modern economies cannot function without silver, and questions are emerging about whether there's sufficient supply. The Ministry of Commerce document from Beijing is confirmation that the supply situation is tightening. But it won't be the last development. The Western paper market has been operating on borrowed time, borrowing metal from ETFs, borrowing from central banks, borrowing from future production. And the future is arriving. Delivery is being demanded and supply is constrained. Silver at $79.30 isn't the end of the story. Whether you view it as a bubble or a repricing event depends entirely on your assessment of the underlying fundamentals. The mainstream financial media will run various narratives. They'll talk about tops and reversals and smart money exiting. The volatility ahead will be extreme. We'll see days where silver drops $5 or more. We'll see shakeouts. We'll see headlines designed to create uncertainty. Peter Grant from Zana Metals warned that year-end profit-taking remains a risk, even as the broader trend has stayed powerful. Some market participants will take profits. That's natural, that's healthy, and it can set up the next leg of any sustained move. The futures market reopens tonight. The stock market reopens tomorrow. Volatility is coming. Gaps are coming. Market dynamics are shifting. The time for analysis is now. The price is $79.30. The next levels being watched are 80, then 85, then 100, then territory we've never seen before. This is the silver market update. China just implemented export controls. The supply equation just changed. And the only thing certain is that Monday morning is going to be extremely interesting to watch. Thanks for watching. Like, comment, subscribe. I'll see you in the next one.